You know that feeling when a brown envelope lands on the mat and the whole day changes shape. You make a cup of tea, sit down slowly, and stare at it as if it might explain itself before you open it. Part of you thinks, I must deal with this now, and part of you wants to hide it under the newspaper until Monday. And underneath all that is the real worry, which is that one wrong move with tax can quietly cost you money. If you like having this sort of calm, plain English help nearby, do subscribe, because this channel is built for people who want the truth without the fuss. Today, we are talking about tax returns after 60 and why so many decent, careful people keep filling them in when they may not need to. The big theme running through this whole video is very simple, and I want you to keep it in your mind from start to finish. Do not do tax by habit once you are older. Do tax by what is true now. There are 7 places people over 60 often get tripped up, and each one starts with something ordinary that turns into a tax problem by mistake. A pension starts, a bit of work stops, a room is no longer let out, a savings account pays more interest, or a one-off withdrawal changes the picture. The trouble is that the paperwork often carries on as if your life has not changed, and many people carry on right along with it. If that sounds useful already, you are very welcome to subscribe and keep this kind of steady company close by. First, think about the person who has filled in a tax return for years and now treats it like brushing their teeth in January. They may not enjoy it, but it has become part of life. So when the reminder comes, they assume the answer is to sit down and do it again. That is where a great many older people lose money, time, and peace of mind, because routine can carry on long after the reason has gone. A habit is not a tax rule, and after 60, that difference matters more than ever. The rule here is straightforward, but it catches people out because it has 2 parts that seem to pull against each other at the same time. If HM Revenue and Customs asks you to send a tax return, you must not ignore that request just because you think you no longer need one. But if your situation has changed, for example, you stopped self-employment or no longer rent out property, you may be able to come out of self-assessment. The costly mistake is assuming one of those truths cancels the other before HMRC has actually agreed. So here is the practical phrase I would write down on a notepad and keep near the kettle. Please remove me from self-assessment for this tax year. That is the conversation you may need if the reason you once filed no longer applies, and it is better handled early rather than in a late panic. You will usually need your national insurance number and your unique taxpayer reference, which is often shortened to UTR, to sort this properly. And the wider principle comes back again here, which is that your past tax life does not automatically define your present one. I have spoken to plenty of people over the years who thought stopping a business or giving up a rental was the end of the story. Then January came, the forms still appeared, and they found themselves anxious, late, or paying for help they might not have needed at all. The quiet relief comes when you realize the right move may not be another evening lost to old paperwork, but a proper request to stop. If this sort of practical untangling helps you feel more in control, subscribe and stay with me for the rest. Second, let us talk about the pension confusion that catches very sensible people as soon as retirement starts to have more than one income stream. One pension arrives here, the state pension arrives there, perhaps a small job ends, perhaps another annuity begins, and suddenly nobody feels sure what is taxed where. Many people assume that if money reaches their bank account, the tax must already have been dealt with somewhere by someone in the system. That assumption is one of the biggest sources of worry later on. The rule to remember is that the state pension is taxable income, but it is not paid with tax taken off before it reaches you. If you also have a private pension, the provider may collect tax through that pension, and if the state pension is your only income, you may instead get a simple assessment bill. That matters because many people think a tax return is the normal answer to every pension tax issue when often it is not. Again, the danger is not age itself. It is treating every official tax problem as if it needs the same old official tool. Here is the phrase I would want you to remember. State pension is taxable, but not taxed at source. Say that out loud if you need to, because it clears up a lot of muddle in one go and helps you ask better questions. Instead of saying, why are they taxing me twice, you start asking, which income source is collecting the tax, and is the code right? That is a much calmer and much cheaper place to begin. The people who do best in retirement tax are not always the cleverest people in the room. and they are certainly not the ones using the fanciest language. They are the people who stop, separate each income stream, and ask what is being taxed automatically, what is not, and what HMRC may bill another way. That one pause can stop a needless tax return, and it can also stop a needless argument with yourself at the kitchen table. If you want more quiet explanations like that, subscribe, because this channel exists for exactly these ordinary but important moments. Third, picture the moment a boiler fails, the roof starts leaking, or a daughter needs a bit of help with a deposit. You look at the pension pot you spent years building and think, I will just take a chunk out, sort the problem, and move on. That sounds reasonable, and sometimes it is, but this is where retirement tax can turn unexpectedly sharp in a single afternoon. One withdrawal can be taxed in a way that feels far harsher than you expected. The rule here is that a flexible pension withdrawal can trigger what people often call emergency tax, especially on a one-off payment. In plain English, the system may act as if that one payment is part of a much larger regular income pattern than it really is. So a person takes money for a real need and then feels sick when they see how much has been deducted before it even lands. That is not always the final position, but it can still be a nasty shock if nobody warned you. Let me give you a real sort of story, even though the name is changed, because this is exactly how these things feel in real life. Malcolm was 67, widowed, careful with money, and proud of never having missed a bill in his life, not even in the lean years. He took money from a private pension to replace rotten windows before winter, saw more tax taken than he expected, and immediately thought he had done something wrong. What upset him most was not just the loss of cash. It was the feeling that the system had suddenly turned against him. The relief phrase for this point is this: emergency tax on a pension withdrawal may be reclaimable, so do not assume the first deduction is the final truth. If too much tax has been taken, there are HMRC routes to reclaim an overpayment, and that is worth knowing before you start blaming yourself. The bigger principle is that one-off pension actions should never be judged by panic in the first hour after the payment arrives. And if you would find it helpful to have someone keep watch on traps like this with you, subscribe and let this channel sit in your corner. Fourth, think about all the little bits of income that do not feel like a business and therefore do not feel like tax return territory. A bit of rent from a former buy-to-let, a room let out for part of the year, some consulting work after retirement, dividends, savings interest, or money from abroad. Each piece can feel too small or too ordinary to matter, especially when it arrives mixed in with pension income and normal household life. But tax trouble often begins in the words, "It was only a little bit." The rule is not that every extra pound means a tax return, because life is not that crude and the system has allowances and different ways of collecting tax. The rule is that untaxed income, property income, self-employment income, foreign income, capital gains, and some other situations can mean you need to tell HMRC or file. This is where people over 60 often make an expensive guess, either filing when they did not need to or failing to act when they should. Guesswork is comforting for about a week, and then it becomes very expensive. So write down this phrase: do I need to tell HMRC about this income, or is it already being dealt with another way? That question is far better than asking, do I fancy doing a tax return this year, because it sends you to the real issue. There are also tax-free allowances for some types of property and trading income, but the point is not to assume you qualify without checking. The theme comes back again. Do not do tax by habit, and do not do it by hunch either. I know this point can sound fiddly, but it matters because retirement finances are often made up of many small streams rather than one big wage. That makes it easier to miss something and also easier to overreact to something that may already be covered by a different process. A calm 5-minute check on the nature of the income can save you weeks of worry, and it can stop you dragging yourself into self-assessment unnecessarily. If you think this sort of plain sorting out deserves a place in your week, subscribe and keep me company here. Fifth, let us deal with the bit of paper people ignore because it looks boring and then regret because it was trying to warn them. I mean the tax code notice, the update in your personal tax account, or the small change that seems too minor to bother with. When retirement income comes from more than one place, a wrong code can quietly build a problem for months before anybody notices, and by the time it is noticed, the amount feels personal, even though it began as an administrative mismatch. The rule is that tax codes can change when your circumstances change, and retirement brings exactly the sort of changes that often trigger that. A new pension starts, the weekly state pension amount changes, savings interest goes above the allowance, benefits shift, or an old mistake needs correcting. Many older viewers think tax codes are really for working people, but that is simply not true once you have several income sources in play. A wrong code in retirement is not rare, it is common, and it deserves attention. The phrase to write down here is this: check the code before the deadline, not after the damage. That means checking what HMRC thinks your jobs and pensions are for the year, which provider is collecting which tax, and whether anything looks plainly wrong. If you wait until the end because the letters felt dull, you are giving confusion months to spread roots through your finances. The deeper principle is that a small mismatch left alone becomes a large worry later. This is one of those points where calm beats confidence every single time. You do not need to be good at tax language to notice that a pension has been counted twice, missed completely, or attached to the wrong code. You only need the willingness to look while there is still time to get it corrected without drama. And if having a steady voice beside you for these things would help, subscribe, because that is what I am trying to be here. Sixth, there is a special kind of panic that arrives when someone gets a tax letter and thinks, right, I had better start filling in a return. The letter may not even be asking for that, but once the pulse goes up, people often reach for the tool they remember from years ago. This is especially common with older viewers whose only real tax issue is now the state pension or another straightforward underpayment. So let us separate two things that sound similar but are not the same at all. The rule is this: a simple assessment is not the same thing as self-assessment. A simple assessment is HMRC telling you what tax they think you owe in a fairly straightforward case, often where tax cannot be taken automatically or state pension tax is due. That means the right response may be to check the figures and pay or query them, not to launch yourself into a full tax return out of habit. Once again, the old key is not always the key for the door now in front of you. Here is the phrase to remember: simple assessment is a bill to check, not a tax return to invent. If the figures look wrong, you should challenge them quickly and be clear about which numbers you think are incorrect and why. The important part is speed, because if you think the calculation is wrong, you are expected to act within the stated window, not 6 months later. And even then, the answer is still facts and records, not fear. I think of Sheila, aged 72, who got one of these letters after years of hearing friends talk about self-assessment as if it covered everything under the sun. She started hunting for old forms, ringing family members, and nearly paid an advisor to complete a return nobody had actually asked for. What she really needed was to compare the figures in the letter with her pension records and deal with the bill as the letter described. If you value having this kind of calm translation from official language into ordinary language, subscribe and keep this channel close. Seventh, we have to talk about deadlines and scams, because panic makes people vulnerable to both, and older viewers are too often targeted right at that point. Someone realizes they may have tax to sort, leaves it late, then gets a message promising a rebate or warning of urgent action. The mind is already tired, the dates are rushing closer, and that is when a dangerous text or email can sound oddly believable. This is not about being foolish, it is about being rushed, and rushed people are easier to trick. The rule side is simple enough to say, even if it can feel annoying to live with. If you need to tell HMRC, you must usually do that by the 5th of October. Paper returns are due by the end of October, and online returns and payment are due by the end of January. There are penalties for late filing and late payment, and they can grow if you leave things drifting for months. So delay is expensive, but panic is expensive too, and that is why your pace matters. Now add the scam rule on top, because this may save somebody watching today from a rotten shock. HMRC does not text you out of the blue asking for personal or payment details for a rebate, and suspicious HMRC-style texts can be forwarded to 60599. Suspicious emails that pretend to be HMRC can be forwarded to phishing@hmrc.gov.uk and then deleted instead of clicked in a hurry. The phrase for this whole point is one I would love every viewer to remember: slow down, check the source, then check the date. If you miss everything else in this video, do not miss this final summary of the 7 points. Older people do not usually get into tax trouble because they are careless. They get into trouble because an old process, a changed life, and a scary letter meet on the same day. So if this kind of grounded guidance feels worth keeping in your life, subscribe, and let us keep making sense of these things together. You do not need pressure. You need a clear head and the right next step. Before we close, let me give you a simple ritual I think is worth adopting every tax year after 60. Sit down with one page and write four things only: what money came in, who paid it, what tax was already taken, and whether HMRC has actually asked for anything. That tiny ritual can stop so much confusion because it puts facts ahead of fear and current life ahead of old habits. And if you know a brother, sister, neighbour, old workmate, or parent who still treats every HMRC envelope like a private crisis, send this video to them gently. I want to leave you with one picture, because sometimes a picture stays in the mind better than a rule. A lot of people over 60 are carrying a ring of old tax keys, and some of those keys did once open the right doors at the right time. But life changes, income changes, the lock changes, and there is no dignity in forcing the wrong key just because it used to fit. There is great dignity in stopping, looking carefully, choosing the right key, and opening only the door that is truly yours now. That is the heart of it. Do not let habit do your tax thinking for you, and do not let fear do it either. A calm check of what is true now can save money, save stress, and give you back a bit of peace.